Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Currency Analyst at MUFG. It's Friday, 13th May 2022, and joining Lee to pose some questions on the financial market themes for the week ahead is Simon Mays, Director of MUFG's Global Customer Marketing Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Lee. Good to see you. How's your week been?
Yeah, it's been very good, Simon. How are you?
Yeah, we've been kept busy this week. As you've seen, it's been a very volatile week for financial markets and plenty of focus on US inflation data as well. So how would you say this has played out on the FX market this week?
Yeah, I think certainly in terms of FX market performance this week, it's been, I think, mainly driven by what we're seeing in terms of the weakness in equity markets globally. Certainly the kind of more risk-off trading that we've seen this week, that's been the kind of main driver of FX market performance. In particular, if you look at kind of the traditional safe haven currencies, the ones you would expect to outperform when you're in a more kind of period of intense risk aversion, those currencies have outperformed, such as the dollar, but also the yen, which is obviously a change to what we've seen recently when the yen has obviously been weakening very sharply over the last month or so. But certainly over the past week, we have seen kind of tentative signs that we could be seeing a kind of reversal for the yen, with that starting to rebound. That's obviously been kind of backed up as well by the reversal we've seen in bond markets with global yields as well, kind of correcting lower over the past week. So we think this kind of more intense period of risk aversion in markets, we think that's likely to continue in the near term, and we still think that there is room for the yen to continue to rebound from very weak levels, particularly when you look at the positioning as well in the market. Like I said, short yen positions have been built up quite significantly over the last couple of weeks. So there is potential there for a squeeze of those yen short positions, and that could certainly lead to some further upside for the yen in the current market environment. And like I said, we don't see any kind of immediate circuit breaker on the horizon to kind of help ease the selling pressure that we're seeing for risk assets. Like we all know, I guess the main kind of fundamental triggers for this sell-off in risk assets and global equity markets has been building kind of market fears over the slowing outlook for global growth. And that, combined with more persistent inflation pressure as well, is obviously putting more and more pressure on major central banks to keep tightening global liquidity conditions. And that tightening in global liquidity conditions is certainly creating more challenging conditions for risk assets. And it's difficult to see what's going to kind of turn that around in the short term. If anything, if we look at comments from Fed officials, ECB officials over the past week, they're all continuing to talk up the need to be even faster in terms of tightening policy. So no real kind of signs of concern yet that they're worried about this tightening we're seeing in financial conditions and weakness in equity markets. So we have to assume that conditions will remain challenging for risk assets. And we've, in our latest FX Weekly report, we've recommended adding a new short Aussie yen position to take advantage of that deteriorating outlook for risk sentiment going forward.
That makes sense. One of the currency pairs that I've had a lot of questions about this week is euro dollar, and in particular its proximity to parity at the moment, and it's become a bit of a buzzword of late. So do you expect euro dollar to follow likes of euro Swiss and dollar Swiss and to hit parity?
Yes, and I think certainly the likelihood of euro dollar also falling to parity is increasing. As we've seen, we've taken out some big resistance levels over the past week with euro dollar breaking below kind of 105. That certainly opened up the market for a test of the lows from back in early 2017 at 103.40. So far, we haven't taken that out, but if we were to break below 103.40, we don't really see much in the way of kind of technical support really until we get down towards parity. So if we do go through that 103.40 level, we could see a further kind of lurch lower towards parity in the coming weeks and months. And that's certainly what's kind of being signaled in the FX options market as well. If you look at Bloomberg's own FX forecasting model, that is signaling that the options market is pricing in about a 1 in 5 probability of euro dollar falling to parity by the end of Q2, and as much as 1 in 2 probability by the end of this year. And, we broadly agree with that. I think certainly in the very short term, risks are still very much kind of skewed to the downside for euro dollar. Fundamentally, the main kind of reason why we're seeing euro dollar coming under such intense selling pressure is actually the kind of building expectations for a wider divergence between European economies and the US economy. And obviously the kind of key reason why there is kind of an expectation that we're going to see more extreme divergence opening up between the US and Europe is obviously the ongoing conflict that we're seeing over in the Ukraine, and obviously the negative fallout that could have for Europe's economy, which understandably is expected to be hit much harder than the US economy from this negative shock. And on that side of thing, it was quite telling that when euro dollar did break lower again towards the end of this week, it was triggered by further bad news on the Ukraine front. So we heard that Russia has imposed more sanctions on European countries, and that led to some of the gas supply to Germany being shut down. Admittedly, only a relatively small portion. I think German officials said it accounts for around 3% of gas imports into Germany. But nevertheless, I think to us it's understandable that market participants have become even more fearful that Russia could continue to use energy supplies as a weapon to hit back at Western countries, which are obviously very much in opposition to their action in Ukraine. And that's to us still very much the kind of main downside risk for Europe's economy going forward. If Russia was to further extend these energy supply restrictions and to hit the major economies like Germany or Italy even harder going forward, then that would increase the risk of an even sharper slowdown of growth in Europe. And that would then feed through to further expectations of underperformance for Europe's economy relative to the US. So it does make sense to us that we are kind of moving down to more extreme undervalued levels now in euro dollar. Certainly if Russia was to take further drastic action to hit European economies, then we could certainly get below parity in euro dollar in the coming weeks and coming months and quarters. I think that's certainly a more and more likely scenario.
Thank you very much, Lee. And thanks for your thoughts in general. Have a good weekend.
Great. Thanks, Simon.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.